Financial reporting. Chapter 1 to 16 we have so far. Okay. 1 to 16 we have covered so far. Now we are moving towards chapter 17 onward. Chapter 17, 18, 19, 20, 21. From chapter 17 to 21. The next 5 chapters are based on one topic, that is consolidation. From where we can expect a long question. If no long question, at least 10 marks will be tested in short questions. An important topic from examination point of view. Consolidation. What is consolidation? If a company whose name is say P has acquired another company S by more than 50%. At least 51%. More than 50%. Then P will be called parent company or holding company, and S will be called its subsidiary. If a company, say P, has acquired another company, say S, by more than 50%, this means S is a subsidiary of P, mean parent company. Can you understand this? P is parent or holding company, and S is subsidiary. Mean they have married with each other. P is husband and S is and after acquisition, all the assets of wife will be asset of husband. All the liabilities of wife will be liabilities of. Can you understand this? Parent and subsidiary. If P acquired 45% of S, S is not a subsidiary. When it will become subsidiary? When parent companies are having a control over another company. Control mean holding must be more than 50%. Not only holding. Being a more than 50% holding, they can influence the decision making of that company as well. They can influence the decision making of that company. Mean if company is going to decide something new and they need approval from owners. And if some owner saying something different, other owner saying something different, how the decision can be finalized? Through number of votes. This means being a parent company, if your holding is more than 50%, you will be having more number of votes as compared to other shareholder, other owners. I mean, you can influence decision making. If holding, obviously, you cannot influence decision making. You are having no control over that business. So in that case, there will be no parent subsidiary relationship. And now P has to prepare consolidated financial statement. Mean S will prepare their own financial statements. P will prepare their own financial statements, as well as P have to prepare consolidated financial statements. Margin. Yes, sir? Margin. No, merger is something different. Merger is something different. Mean here, two companies both operating separately. Both companies operating separately. In merger, they merge with each other with same name. Here, their identity will remain separate. But as this company P has acquired more than 50% share capital of that company S, so now it will call it subsidiary. So in case of parent subsidiary relationship, parent company have to prepare consolidated financial statements. And before preparing consolidated financial statements, we need to see what is the holding of parent company in subsidiary. It could be either 60%, it could be either 80%, it could be either 75%, even it could be either 100%. If they have acquired 80%, the remaining 20% is investment of other shareholders. In parent company acquired 80% of subsidiary share capital. This means 20% is other shareholder. So that other shareholder will be called non-controlling interest, NCI. NCI is other shareholders holding in the subsidiary. If you acquired 100%, there is no non-controlling interest. But if you acquired less than 100%, there will be some part of non-controlling interest, other investors. Can you understand this? Okay. What is goodwill? What is goodwill? Initial amount paid over net assets. Initial amount paid over assets. Additional amounts paid over net assets. If the subsidiary assets value is say 70 million, but you paid to acquire subsidiary that is 90 million. The additional 20 million that you pay over the asset, that will be called what? Goodwill, due to repute of the business. Due to repute of the business. Is that? So let's move forward straightway to our question. Not this. That's your understanding. What you need to do. Prepare the consolidated statement of financial position. Mean balance sheet of Dickens at 31st December 20x8. Year end is 31st December 20x8, and we need to prepare consolidated statement of financial position. How to prepare statement of financial position? Non-current assets, current assets, equity, non-current liabilities, current liabilities. Is that? Yeah. The following statement of financial position have been prepared at 31st December 20x8. Dickens and Johns. Property, plant and equipment value for both is given. Investment shares in Johns. Mean who made the investment in whom? Dickens made the investment in Johns. This means Dickens is a parent company and Johns is subsidiary. And they acquired John's company. How much we don't know, but they paid 60,000. And then current assets for both companies, equity for both companies at 31st December 2028. And we need to prepare at 31st December 2028 as well. I mean, this is the reporting data given. Share premium for both companies, retained earnings for both companies. Is that opening or closing? Closing, including current year profit. Including current year profit. And current liabilities for both companies are given. Because acquired 16,000 ordinary share and the value per share is 1 in John's on 1st January 2028. How many shares John's are having? 20,000. Out of this, they acquired 16,000. Can you calculate the percentage of holding? 80. 80%. How you have calculated this? 16 divided by 20,000 multiplied by 100. So we got 80% holding. So they acquired this 80% holding. This means 20% is what? Non-controlling interest. Okay. So on 1st January, mean at start of the year, they acquired when John's retained earnings stood at 20,000. Mean on 1st January, their retained earning were 20,000. Now they have 25,000. Mean at start of year, their retained earning was 20,000. Now they are having 25,000, mean 5,000 added during the year. Mean relating to profit for the current year. And its share premium was 10,000. What's the share premium now? Same 10,000. Mean there is no change in share premium. On this date, the fair value of the 20% non-controlling shareholding in John was 12,500. What does that mean? We don't know. We will discuss later. The Dickens Group uses the fair value method to value the non-controlling interest. So we need to prepare consolidated statement of financial position. What we need to do? Property, plant and equipment, both figures we will add. In consolidated financial statements, property, plant and equipment figure will be 85 plus 18. That will be 103,000. Instead of investment, we record an account balance with the name goodwill, and goodwill amount we will calculate from working to. No investment will be there. Instead of investment, we need to record goodwill. Current assets for both the company we need to add. How much that will be? 244 or 24? 244,000. So we will be able to calculate total assets. In equity, we will record only parent company share capital. That is what? 65,000. Only parent. Share premium, we will record only parent. That will be 35,000. Mean this data we are preparing for consolidation. Consolidated statement of financial position. Retained earning we need to calculate. And for this, we will perform working for. And under equity, we need to record an other account balance that will be called non-controlling interest. That we will calculate from working sheet. And non-current liabilities, current liabilities, we will add together. So current liability will be 135 plus 47, 182. Will make up. This means we need to calculate goodwill. We need to calculate parent company retained earnings. We need to calculate non-controlling interest. And by having these three figures, we will be able to complete statement of financial position. Can you understand this? I'm covering very basic level question that is relating to financial accounting, not at this level. But we forgot that. Might be we studied financial accounting 2 years back. So how we will start? First of all, we need to start our working one relating to net assets. Relating to net assets of subsidiary. Who is subsidiary here? Jones. And we need to make 3 columns. We need to see what are the net assets at acquisition date. We need to see what are the net assets value at reporting date. And what is a change after acquisition? The period before acquisition will be called pre-acquisition. The period after acquisition of subsidiary will be called post-acquisition. The net assets figure at the time of acquisition, net assets figure at the reporting date, mean year end date, that is given. And what is change post-acquisition? What we record here, we record these figures. Share capital, share premium, retained earning. If there is any revaluation reserve, we will record that as well. So share capital, share premium, and retained earning. We are having only 3 account balance in this question. About what? Net assets of subsidiary. And these figures are given at reporting date. To put in the reporting date 20,000, 10,000, and 25,000. Normally, share capital and share premium figure remain same at the time of acquisition and at reporting date for subsidiary. So same we will put here. While retained earning for subsidiary at the time of acquisition, that figure is given in the question. How much? On 1st January 2008, when John's retained earning at 20,000 and his share premium was 10,000. That 10,000. But this retained earnings at the time of acquisition was 20,000. What is the total of net assets at acquisition date? What is the total at reporting date? In post-acquisition, there is no change. But here in retained earning, there is a change of 5,000. This means this subsidiary generated 5,000 profit after acquisition. That's why retained earning increased by 5,000. Because current year profit we need to add where? In retained earning. Out of this 5,000, how much is a parent and how much is for non-controlling interest? So for parent and non-controlling interest, parent is what? 80%. That is what? 4,000. And for non-controlling interest is what? 20%. That is what? 1,000. Are you with me? First, we need to calculate what? Net assets of subsidiary at the time of acquisition, at the reporting date, and we need to see what is change after acquisition. And retained earning change is due to profit. And out of that profit, some portion is of parent company and some portion is of non-controlling interest. And how much is that? That we have calculated. Now we can calculate figure for goodwill. Without this, we cannot calculate figure for goodwill. We cannot calculate figure for this retained earning. We cannot calculate figure for non-controlling interest. Because we need to calculate these three figures now. Goodwill, retained earning, because only parent we will need and non-controlling interest will. So let's discuss how to calculate this. So working to goodwill. How we can calculate goodwill? We'll take consideration paid. Consideration paid. We can say fair value of consideration paid. How much you paid to acquire this company? Is given 60,000, the investment you made. In that, we will add fair value of non-controlling interest. Fair value of non-controlling interest. And this figure is normally given in the question. On this date, what date? Acquisition. The fair value of the 20% non-controlling interest in John was 12,005. We need to add this because we are taking total assets. And out of total assets, some portion is of what? Non-controlling interest. That's why we need to add it. Fair value of non-controlling interest that is normally given in the question. What was that figure? 25,000. No, 12,500. 12,500. And we are having a figure that is 72,500. From this figure, we need to deduct fair value of assets acquired. Fair value of net assets acquired, not assets. And this figure we can take from where? Working one. What is fair value of net assets acquired? What we have calculated net assets. At the time of acquisition, what was its value? 50,000. So fair value of net assets acquired is what? 50,000 that we will did. Now we are having goodwill. That is what? 22,500. From this value, we need to deduct impairment of goodwill. If information is given in the question. In this question, there is no information given for impairment. So 22,500, that will be goodwill, financial statements goodwill or consolidated goodwill. If there is information of impairment available for goodwill, we need to deduct that. If there is no information, simply put this as a goodwill. This means goodwill, we have calculated how much, 22,500, put it here. Even we can calculate total assets. 103 plus 22,500 plus 244. How much is that?
369,512.
365. Now, if we can calculate parent company's retained earning and non-controlling interest, question is completed. So let's move towards calculating non-controlling interest. Working 3. How to calculate non-controlling interest? Fair value of non-controlling interest at the time of acquisition. What was that? 12,500. That is available in the question. In that, we need to add subsidiary profit share. Subsidiary profit share. That was how much? 1,000. How we calculated that? 5,000 multiplied by 20%. So that is 1,000. Is that? So now we can calculate non-controlling interest. That is 13,500. Put is here. 13,500. Are you with me? Now we need to calculate parent company retained earning. Let's open working 4. Sorry.
For all questions, you can use the same.
We will add one more figure. What will be that? We will see in future. To make it simple, NCI at the start of acquisition. In that, we need to add subsidiaries profit share of NCI. So retained earning for parent company, we need to calculate. What are the parent company retained earning? Available in the financial statements. So parent retained earning, that is 70,000 given in the question. In that, we need to add subsidiary profit share 5,000, 80%. That is what? 4,000. So will become 74,000. So we will add here 74,000 and see whether it's tally with each other. Is that?
Identify parental profit share.
Parents own retained earning. In that subsidiaries profit share. What was subsidiary profit? 5,000. 80% was its share. 74,000. This we will record here. Only parent.
It means share of subsidiary profit.
No. Parents share of subsidiary profit.
Yeah.
Subsidiary profit share mean parents share in subsidiary profit. So subsidiary P's share of subsidiary profit, you can write that. P's share of subsidiary profit. So first we need to start working of net assets of subsidiary at acquisition date, at reporting date, and post acquisition change. From that, we can calculate what is the profit of subsidiary. Then we should start working of goodwill, consideration paid, add fair value of non-controlling interest minus fair value of net assets acquired. If there is any impairment, that will be deducted. And then non-controlling interest, fair value of non-controlling interest at the time of acquisition, add subsidiary profit share for NCR. And then we need to calculate parent retained earning. Because the subsidiary retained earning, we don't consolidate, we only consolidate subsidiary profit for the year after acquisition. Shall we move forward? Okay. Okay, now we should study something. So first we need to find what is the holding of parent company in subsidiary. Through this, we will be able to identify what is the holding of non-controlling interest. This is important. Secondly, we need to identify net assets of subsidiary at the time of acquisition, but it will include share capital, share premium, retained earning, any revaluation surplus at reporting date, and what is the change. How we can calculate goodwill? Holding company investment at fair value mean fair value of consideration paid. Add non-controlling interest at the time of acquisition. From this, we need to deduct fair value of net assets acquired. And we need to deduct impairment, so we can calculate goodwill amount that should be capitalized instead of investment. Non-controlling interest figure, how we can calculate non-controlling interest at the time of acquisition. Add non-controlling share of post-acquisition reserve mean in subsidiary profit share. and deducting share of impairment. When we will discuss later on. In whatever the impairment we calculated here, from this 80% is of parent company, 20% is of subsidiary. So we need to deduct 20% of this in non-controlling interest and 80% from parent company retained earning, when we will discuss later on. How to calculate a group's retained earning, parent company retained earning, subsidiary profit share, and retained earning share. If goodwill amount is becoming negative, if a goodwill amount is becoming negative, what does that mean? We paid less than company asset worth. We paid less than company worth. We gained something. We gained something. If goodwill amount is negative, that will not be recorded as asset. That will be added to parent company retainer. Mean positive goodwill. Also called gain on bargain purchase. Mean 70,000 asset worth you took in 60,000. How? This was your bargain. If you don't come under us, you will die. We will destroy. Will not allow you to operate in the market. We will see you. So either take 60,000, otherwise you will be losing all. What is this? Bargain. In goodwill amount is negative. So that will be added to group's retained earning. If positive goodwill, that will be recorded as non-current assets. If negative, that will be added to group's retained earning. Can you understand this? Okay. Now, non-controlling interest can be calculated by using two methods. One is called fair value method and other is called proportion of net assets method. Fair value method and proportion of net assets method. What is proportion of net assets method? The net assets that we calculated in working one at the time of acquisition. This figure multiply by non-controlling interest percentage. That is non-controlling interest at the time of acquisition. Fair value of net assets at the time of acquisition multiply by non-controlling interest percentage mean 20%. If the figure is not given in the question for non-controlling interest at the start of acquisition, that we need to add in goodwill and we need to add in non-controlling interest figure. If the figure is not given, how we can calculate? Proportionate of net asset method, mean net assets at the time of acquisition that we have already calculated in working one. So multiply non-controlling interest percentage mean 20%. So this is one method of calculating non-controlling interest at the time of acquisition. Because we need to use this figure in goodwill calculation. And we need to use this figure in non-controlling interest figure as well, because opening and then adding subsidiary profit share. Is that? What's the other method? Other method is called fair value method. And normally using this method figure is given in the question. Or we can calculate how we can calculate Fair value of a non-controlling interest holding at acquisition. In number of shares. If suppose subsidiaries shares were 100,000, 80,000 we acquired. How much remaining? 20,000. How much remaining? 20,000. For this 20,000, we need to see what is the market value of shares, mean fair value of shares. Suppose book value, par value is 1. Market value is 1.5. So 30,000 mean into 1.5. 30,000 will be fair value of non-controlling interest at the time of acquisition. Can you understand this? 30,000 is the fair value of non-controlling interest at the time of acquisition. And normally this figure is given in the question. So how non-controlling interest at acquisition can be calculated using fair value method? Mean number of shares of non-controlling interest multiplied by fair value of shares. Are using proportion of net assets. Net assets acquired at the time of acquisition multiplied by non-controlling interest proportion percentage. Can you understand this? If goodwill is positive, treat it as non-current assets. If it is negative, the acquisition is regarded as bargain purchase and gain is included within group retained earnings. If non-controlling interest figure is calculated on fair value method, then we need to deduct impairment share from non-controlling interest calculation. If we have calculated non-controlling interest using this method, then any impairment of goodwill will also be deducted from group retained earning and non-controlling interest. If non-controlling interest was calculated on proportion of net assets basis, then we will not deduct impairment from non-controlling interest and group retained earning. Mean when this share of impairment will be deducted in case non-controlling interest was calculated on fair value. If it was calculated on net asset proportion method, then impairment will not be deducted. Formula will remain simple that we used in question. That in that question, there was no impairment. If there was impairment, we need to use this as well because the figure in question was fair value method. There was a line in question using fair value method. Mean in case of only fair value method, in case of proportion of net assets method, this impairment will not be deducted, not here, not here. Can you understand this? Can you understand this?
CI is second item.
NCI value at the time of acquisition.
Makes sense.
Post acquisition reserve mean profit. of subsidiary share. Share of subsidiary profit. NCI share of post-acquisition reserve mean post-acquisition reserve. Reserve mean profit. If there is any revaluation reserve, that will also be included. And then deducting NCI share of impairment, but only if NCI is calculated using fair value method. Not in case of proportionate of net asset method. So group retained earning, how we can calculate? Parent company's retained earning, reporting date. Parent company's share of post-acquisition retained earning of subsidiary. And if NCI was calculated using fair value, then impairment as well. And goodwill, if negative, that is in most of the question, NCI is calculated on fair value basis. This means for group's retained earning formula will be what? Parent retained earning add subsidiary profit share. Even if there is impairment, we don't need to deduct. Why? Because NCI is based on fair value method. NCI is based on, in case of fair value method, we need to deduct impairment. But in case of proportion method, we don't need to deduct. Shall we move forward?
Yes.
Yes, why not? If there are two subsidiaries, doesn't matter. We will calculate goodwill for both subsidiaries and we'll add. We will add both subsidiaries profit share. Mean net assets we need to calculate for both subsidiaries. Goodwill we need to calculate for both subsidiaries. NCI we need to calculate for both subsidiaries. And in consolidation, we will add both goodwill. We will add both NCI. No issue with that. So what is goodwill? How it is calculated? If it is negative, what we need to do? If it is positive, capitalize as intangible non-current assets, tested annually for impairment. Amortization of goodwill is not permitted. Why? Because goodwill life cannot be determined. Cannot be estimated. That's why no amortization of goodwill is allowed, though goodwill is intangible asset. Now, intangibles we need to amortize over their useful life, but goodwill is not allowed for amortization. 10 years back, goodwill was allowed for amortization. But through that, companies were making fraud estimates based on management. So standard clear 10 years back, no amortization will be allowed on goodwill. Goodwill will be only having impairment test. Impairment of goodwill. In case of impairment, what will be the accounting entry? We need to deduct from parent retained earning. So group reserve mean retained earning debit, and goodwill we need to reduce credit. Only in case of fair value method. In case of proportionate net asset method, don't need to deduct impairment from retained earning and non-controlling interest. And from non-controlling interest, mean non-controlling interest debit and goodwill credit mean combined entry will be like this. Negative goodwill. What are post-acquisition reserve mean profit after acquisition. Pre-acqui mean profit before acquisition. Non-controlling interest is what others share in subsidiary company. That's your understanding too. Good luck, everybody. That's your understanding too. I don't know. It's not 40.
And assets from
According to requirement 1, NCI will be measured on proportionate of net assets method. If there is any fair value given, you need to ignore. Even in question, there is no fair value given. What are the net assets? What is their proportion? How to calculate goodwill? Consideration paid. Add non-controlling interest at the time of acquisition, less fair value of net assets acquired. How much consideration you have paid? Jack acquired 60% of the ordinary share capital of Daniel on 31st December 20x6 for 240,000. At this date, the net assets of Daniel were 360. So what is NCI? 40% of 360. Using proportionate of net assets method. In net assets, first column figure is given 360. At this date, when? At the time of acquisition, net assets mean share capital, share premium, reserve are 360. So what is 40% of 360? 144. What is goodwill?
2024.
So this is using option 1. Now we are moving towards option 2. If a fair value of net assets non-controlling interest at the time of acquisition is 150, what is goodwill? 240 we paid. This is what? 150 now. This will remain 360. Are you with me? Sure. Shall we move forward? Illustration 2. Extract from statement of financial position as at 31st March 20x4. When it was started? 1st April 20x3. What you need to do? Calculate the following figures for inclusion within the consolidated statement of financial position of a P group at 31st March. You need to calculate figure for PPE, for goodwill, for share capital, for retained earning, for non-controlling interest. That will be presented under consolidated statement of financial position. They have not asked to prepare consolidated financial position. So they are having three companies, P, S, and T. Who is what we don't know. Property, plant, and equipment for three is given. That we simply add. Investment in S 75% and investment in T 80%. So these we can add all three together, 160 plus 120, that will be 280. But instead of investment, we need to calculate what? Goodwill. Instead of both these, we need to calculate goodwill. For both, we will add from working. Share capital, we record only for parent. Retained earning, that we need to calculate. And non-controlling interest, we need to calculate. P acquired an investment in S and T some years ago. How much? 75% of S and 80% of T. This means 25% and 20% of non-controlling interest. When the retained earnings of these entities were 20,000 and 5,000 respectively at the time of acquisition, but at the time of reporting date, figure given. P values the non-controlling interest using the fair value method. And at the date of acquisition, the fair value of the non-controlling interest in S and T were this. That's it. 21. What net assets of S first. At the time of acquisition, at reporting, and post acquisition. They are having share capital of what? 50 and retained earning of what? 80. Is there anything else? No. Is that acquisition time or reporting time? This is for reporting time, but share capital we know will remain same. At the time of acquisition, its retained earning was 20. How much is the change? 60. This is what? 70. This is what? 130. Out of this 60, 75% is of P, 25% is of non-controlling interest. 15 is what? Non-controlling interest. This is what? For P. Are you with me? Now, net assets of T, share capital of 60, that will remain 60, will no change. And retained earning at reporting date are 20, while at the start was 5. This is 65, this is 80, and change is 15. Out of this, 80% is of parent. How much? 12. Of parent, and 20% is what? 3. that is of non-controlling interest. Is that? Let's move towards working two. Goodwill. Consideration paid. Fair value of NCI and fair value of assets acquired for S and for T. Who will be able to calculate goodwill for both? The consideration paid 120 paid for S and 60 for T. Fair value of net assets required. Oh, sorry, NCI for S is 20,000 and for T 15,000. And we need to deduct 70 and 65. Goodwill for both will be 140 minus 70, 70.
70.
60, 75 minus 65 is the goodwill will be 80 for both.
Yes.
Are you with me? Now, working three, NCI. Fair value of NCI for S and T both. S is 20, T is a 15, and subsidiary share. Subsidiary profit share for this will be 15 and for this will be 3. So NCI figure will be 35 plus 18. So 35 plus 18, how much? 53. And now working for retained earning. Parents on retained earning, that is 220, and share of S and T is profit share altogether 265, 275, 277. Done. There could be 3 subsidiaries. Doesn't matter. You need to perform more calculations. Under working 1, working 2, working 3.
It will have.
You didn't ask what I did. They have provided information here 280, 80, 277, 53. 280, 80, 277, 53. Share capital will remain same for the plant. They didn't ask to prepare consolidated statement of financial position. They asked you need to calculate these figures only. Yeah, obviously. Shall we move forward? Let's move towards one more topic that is called calculation of cost of investment. In how we can calculate cost of investment. cost of investment. Cost of investment means fair value of consideration paid. Sometime we pay one-time amount to acquire subsidiaries. Sometimes we say, okay, we are paying 100,000 now. Remaining 50,000 we will pay after 3 years. We will pay on third anniversary of our wife. I mean after 3 years. So 100,000, that will be cash consideration. And the remaining that we will pay in future. We need to incorporate that amount 50,000, but not 50,000. We need to calculate its present value using the discount factor. And suppose present value is 45,000. So we'll add 45,000 plus 100,000, 145,000 as a consideration paid. In for future payment, future also called deferred or contingent consideration. Future also called deferred or contingent consideration. So that we will incorporate, but using present value method, we will apply discount factor on that. In 50,000, we will pay after 3 years. So what we will do, 50,000 multiply by 1 divided by, suppose discount factor interest rate is 10% raised to power 3. So we will calculate that amount. So that will be part of consideration paid, 100,000 plus, suppose from here we calculated 45,000. So 145 will be consideration paid. Can you understand this? Is that okay? One thing more. So parent company acquiring subsidiary. Paying cash 100,000. Contingent consideration of 50,000 after 3 years. And they are acquiring 80% of subsidiary. And subsidiary is having 10,000 shares. Value per share is 1. This means they are acquiring 80% mean 8,000 shares. And they are saying, we will also pay some amount in terms of shares. P is offering to S, I will pay you my shares as well. In some payment will be in shares. P's share. 2 for 5.
Beyond that, that's
Mean now there are 3 consideration. One is immediate cash, 100,000. Other is contingent consideration that will be paid after 3 years. What to do with contingent consideration? We need to incorporate using present value. Not complete 50,000. We will calculate this present value that we will incorporate. In case of goodwill calculation, first amount we need to take consideration paid. So that consideration paid we are going to calculate. And then P's share. Mean parent company giving some of its share to subsidiary. It's giving some of its shares to subsidiary. 2 for 5. What does that mean? Whatever share we are acquiring, how much we are acquiring? 8,000. Multiply by 2 by 5. How many shares?
200.
3,200? 3,200?
Yeah, 3200.
3,200 share. Suppose parent company share book value is 1 and market value is 1.5. This share amount will always be calculated using market value. Multiplied by 1.5 market value. So this 100,000 will be consideration and this will be discounted, say 45,000 will be consideration, and through this 32,000 multiplied by 1.5, 4,800. So this will be consideration. Fair value of consideration paid. Can you understand this? This is called cost of investment. In how much is your investment? 100, 145 plus 4,800, that is 149. Are you with me? Now we need to read something. Calculation of cost of investment. The cost of acquisition in acquiring subsidiary investment include the following elements: cash paid at the date of acquisition, 100,000 we paid cash. Fair value of any other consideration, for example, deferred contingent consideration and share exchange. Share exchange, not on book value. Fair value mean market value. Fair value of contingent consideration. Mean 50,000 after 3 years, what is their present value now? That is fair. Incidental cost of acquisition such as legal, accounting, valuation, and other professional fees should be written off as expense. In these costs, while acquiring the company, if you are paying to any lawyer who is helping in acquisition, you are paying to any accountant who is calculating net assets of the company and charging a fee, you are paying to any expert who is guessing value of the shares, used assets, you are paying them a fee. Any of the professional you use in acquisition, like any broker, agent, you are paying commission to them. These costs will not be part of investment. These will be treated as expense in profit and loss account. Whose profit and loss account? Parent company, because he is acquiring. Is that fine? And if you are marrying, the amount you are spending for bajas, for luxury car, for your dresses, that will not be investment, that will be expense. You are giving dinner to your guest, that will not be investment, that will be expense. So through profit or loss account, these issue cost of debt or equity associated with the acquisition should be recognized in accordance with IFRS 9. If you acquired money through debt, so that debt will be dealt according to IFRS 9. Cost of capital will include what cash you have paid, what you will pay in future, its present value, and if any share you are giving, its market value. These costs will not be capitalized, will not be part of consideration paid. Deferred or contingent consideration in some situation, part of or all of the purchase consideration is deferred, mean will be paid in future until a later date. Deferred consideration mean it's a promise I will pay in future. There are two ways to discount the deferred amount. You may need to apply the discount fraction to the deferred amount where R is the rate given in the question. Or sometime examiners say present value after 3 years of $1 will be equal to $0.75. So instead calculating present value using this formula, what we will do 50,000 multiplied by 0.75, that will be PV, that will be used. The present value of $1 after 3 years will be 0.75. So what we'll do simply 50,000 multiplied by 0.75. If there is discount factor given, we will calculate using the discount factor. Are you with me? Illustration 3. So look at it, what if you need to calculate cost of investment in consideration paid. Part 1 only. Cash contingent share. Mister, what's the value? 50. So 24 million share they acquire. And 24 is 80% that they acquire. Is that? And they are paying 2 for every 3 shares. Market value of share is what? 2. So 24 million into 2 by 5, how many shares? 9.6. Multiply by market value, that is what? 2? 19.2.
How many you? Why did that 2 by 5?
2 by 3 it is
Share for share exchange of 2 shares for every 3. Sorry, every 3.
That is 2/3, right, sir?
Yeah, 2/3, 2/3. What's 2/3? 16 million. Multiply by 2, 32. And the other consideration is what? And a cash payment of $1 per share payable 3 years later. How many shares? 24. Mean cash consideration $1 will be 24 million. But after 3 years, and they have provided information, after 3 years, $1 will be equal to 0.75. So this is cash and this is share. And cash after 3 years, that will be 24 million into 0.75. 50 will be consideration paid. Are you with me? Let's see this 50. What will be the accounting entry? Investment debit with 50 million. Non-current liability deferred consideration that we calculated will be 80 million for parent company. They need to pay after 3 years. When they need to pay after 3 years. Share capital 16 million. How many shares? 16 million shares. Book value is 1, face value is 1. You are giving on 2, mean there will be half a premium. So share capital will increase by 16 million and share premium will increase by 16 million. If you are giving on 1.5, then with 0.5 share premium. You have created non-current liabilities of 18 million and there is a interest rate that is what? 10%. With that 10%, you need to record finance cost, debit, and that provision that you have created for 18 million liability will be debit. This is called unwinding the discount. Discount means interest. The discount that we covered in environmental provision as well 2 days back. Mean for this year, year 1, the liability will be 18 plus 1.8. And next year, 10% will be charged on 18 plus 1.8. What was that? 19.8. So next year, the interest will be on 19. That will be added. And in next year, interest will be charged on 20 something. At year 3, this will be equal to what? This will be equal to what? 24 million. By adding the finance cost. Can you understand this? In case of contingent consideration, we need to incorporate in calculation, but using discounted method, present value method. And on liability, we need to unwound the discount, mean record the finance cost against liability every year. For how many years? Until the time period. 3 years, for 3 years, 5 years, for 5 years. Let's take a 15 minutes break. After break, we will discuss some things more.